Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. Let's get you up to speed with an hour to go in the trading day. When you take a look at the major averages, we're not too far from the flat line, but the Dow and S&P under pressure today, with the S&P falling below 4,400. In terms of some of the individual moves that we're seeing, financials the worst performer in today's trading action. Some of the banks leading losses there after S&P cut a handful of lenders, citing a very tough climate. You're looking at the Nasdaq, the only one of the major averages holding onto gains here in the final hour, up just about 0.2%. Well, it's a big day for retail. Three big earnings reports from that sector today. Macy's, Dick's Sporting Goods, and Lowe's all giving us a closer look at the consumer. Lowe's is the only stock trading to the upside, up just about nearly 4% after reporting a smaller than expected drop in comp sales in its second quarter. Dick's shares are selling off. We're looking at a loss of just over 23%. That's coming after the company slashed its guidance, talking about retail theft. And Macy's is also moving lower on a cautious outlook. Diane, I had two takeaways from these reports. One, the fact that the consumer is clearly pulling back. We heard that a number of times in Macy's earnings calls from both the CEO, Jeff Gennett, as well as CFO. And what really stuck out to me in that earnings call in particular was what CFO Adrian Mitchell had to say about credit card delinquencies, saying that they accelerated in the second quarter and they accelerated at a much faster pace. And then the other takeaway, the retail thefts, a theme that we've been seeing this earnings season.
Indeed, especially with regard to Macy's, the comments from the CFO standing out to me as well. The quote macro environment having the lion's share of the impact on credit card, and a real indicator of where we think the health of the consumer is. So it's starting to show those cracks that we talked about that could potentially be coming when it comes to the consumer. And, you know, although credit card revenue doesn't account for a significant portion of revenue for Macy's, it shows the potential challenges when it comes to the consumer. And, you know, Macy's talking about the financial pressures shoppers are facing. And you're also seeing other retailers get dinged as well. You're looking at comparable sales that came in, down 7.3%. The estimate was down 9.4%. But Macy's, again, saying that its consumers are under pressure. The credit card balances are rising, and there's that inability to keep up with that. And, to your point also just about the issue with theft, Dick's highlighted that in its earnings release. Dick's CEO saying, quote, our Q2 profitability was short of our expectations due in large part to the impact of elevated inventory shrink, an increasingly serious issue impacting many retailers. We've talked about this with different retailers, and that stood out. Stifel put out a note today about Dick's, noting that the comps were light, coming in short of estimates, and of course, Dick's has talked about business optimization, meaning layoffs, and how that will impact numbers going forward as well. Yeah,
theft when it comes to Dick's is really what stuck out to me. And we heard from a number of analysts at this point over the last couple of hours or so talking about this. And I think that one of the notes that stuck out to me, and just in terms of what we did see, as I find it here, Wedbush analyst Seth Basham there, he wrote in a note today in reaction to this that this is an issue that has negatively impacted many retailers now for some time, but it has not yet been called out from Dick's Sporting Goods previously. So this is the first time that we're hearing it from Dick's, and the fact that they see this issue remaining a challenge in the second half of the year, and so much so that that's the reason why they cut their profit guidance. That really just speaks to how severe this problem is, and the fact that it's impacting so many retailers. What we also didn't really talk much about yet is also Lowe's. The results
I know,
that
on
we
the
got
plus
from
side.
there, beating their on-profit comp sales and actually outperforming its rival Home Depot, which you haven't seen that often over the last several quarters. And we're taking a look at, obviously, the street pretty pleased with these results, with the stock up nearly 4%.
I know. So going into Lowe's results, I know investors were looking to see how it holds up in the face of a potentially weakening consumer, and also that kind of trend around, can the pro side of Lowe's compensate for any kind of decline in regard to all that DIY business that Lowe's benefited from during the pandemic, and kind of an extension of that. So it shows that Lowe's called out a quote strong spring recovery. They had that, so that was one of the call outs in terms of their earnings. They did note there was a little bit of lower of the DIY demand demand, which kind of, weighed a little bit on sales. But again, Lowe's definitely the standout in terms of the bright spots in the retail group. There was Telsey Advisory Group, Dana Telsey's company. They put out a note today, but this is from Joe Feldman. That just also, though, there was a note of caution struck in their note that the industry does face headwinds related to kind of weakness in the housing market and consumers just remaining cautious with spending in general. So this is one to watch, but it is a standout on the plus side today. Major retailers are the latest to take a cautious look on the consumer, and while second quarter results overall have been better than feared, one strategist is sounding the alarm on the broader implications of an earnings recession. Joining us now is Amanda Agati, PNC Asset Management Group Chief Investment Officer. So Amanda, thanks so much for joining us today. Let's talk about this. So we are seeing an earnings recession. Talk has dialed back about an economic recession. What do you think about kind of the market's take on where we are with regard to earnings?
Well, thanks so much for having me. It's great to be with you both. I think the market is only now just this quarter really starting to focus on the underlying fundamentals and the strength of the fundamentals. And I think it is really a bit why we've seen this rally, this torrid rally that's taken hold over the course of this year, take a little bit of a breather here, because I think the results are coming in better than feared this quarter, but it's not enough at these valuation levels to keep this market rally going. And so we think that's going to have important implications, certainly for the second half of this year and into 2024.
Amanda, what are those implications? I guess, what do you see as the downside risk here?
Well, we think expectations are way too high in terms of earnings growth expectations. I think for Q3, we're starting to get closer to reality, as negative revisions have been really a story for the last few months. And so expectations for Q3 are about flat, aka almost no growth on a year-over-year basis. But Q4 still looks like a Hail Mary with a 7 to almost 8% year-over-year growth rate and 12% year-over-year growth for all of 2024. That's just way too high given the backdrop and the march toward a mild recession that we still see in the near term here. And so we do think expectations are going to need to come down. That certainly is going to have important implications for price returns and valuations in the second half. We think it could be as much as 10 to 15% downside just to get a little bit closer in terms of recalibrating to this milder recession scenario looming.
And what sectors worry you the most, given this kind of economic expectation that you have?
Well, I think it's sort of an interesting question, because the ones that worry me the most are the ones that are at almost obscene valuation levels, because I think there's very little headroom or shock absorber. And so those who have been leading the charge on a year-to-date basis, communication services sector, tech sector, even consumer discretionary, I think there are going to be some challenges in the second half. That being said, I'm not necessarily sure that those business models are going to have the same kind of impact that ultimately shifting into a recession might have for some of the other broader parts of the market. So it's a really big gap and distinction between winners and losers, and those who have been leading the charge from market leadership perspective, I think, are the ones that most at risk of valuation multiple contraction. The rest of the pack hasn't seen much of that. But I think, results are going to continue to be challenging. So I think it's more of a question about who's in the driver's seat in terms of the market's path forward. And I think there may be a shift in that baton.
So then, Amanda, given that, how much is riding then on NVIDIA's results after the bell tomorrow, given the fact that there has been a massive run up in the stock, up over 220% since the start of the year, and so much of this AI hype that has really been driving the broader markets is a result of what we heard from NVIDIA specifically?
Well, it feels very much like this market is in a wait and see mode for two things: NVIDIA earnings and then whatever may come out of Jackson Hole later this week. At a 40 times price to sales ratio, I think that's what it is for NVIDIA. It's almost laughable, right? This is an insane valuation level, but it's all a function of FOMO and sentiment driving that one. I think it'll be interesting to see how results come in. They've only missed once in the last 5 years or so, so they have pretty good odds. And certainly demand is there as well. So we think results will come in okay, but it's really a question of, is it enough to keep this rally going in the stock? I think it deserves a breather here.
So you asked the question, who's in the driver's seat, and you talked about Jackson Hole. So we know that Fed officials, economic leaders convening in Wyoming this week for the 2023 Jackson Hole Economic Symposium. So what are your expectations to come out of that this week?
Well, I think the Fed has been and continues to be in the driver's seat for sure. I think they will unlikely change much in way of their tone or messaging out of Jackson Hole. I think it'll be much more of just a reinforcing this, what I describe as a longer for longer dynamic still in place. Some say higher for longer. I go with longer for longer because to me, it's really just a longer overall tightening cycle. Fed's in the driver's seat for longer than any of us, I think, would like. And I think the market is maybe underappreciating potentially another couple of moves on the part of the Fed. And so we don't see rate cuts coming until much later in 2024. And so I think that's going to have important implications for the path forward for the market. We're hunkering down ahead of the Jackson Hole speech for sure.
So then along those lines, do you also think that the market's being a little bit too optimistic? When I'm taking a look at the Fed Funds futures here, the CME target 84, almost 85% of investors, of traders, expect the Fed to hold flat at its next meeting in September. Is that still a bit too optimistic, given the fact that a lot of the data points to a pretty resilient economy?
I think it could be a little bit optimistic. We think they could do maybe one or at most two more rate hikes in the balance of the year here. But I think we need a few more data points to really confirm whether September is a live meeting or not. I keep saying that this is really, for investors, very much a choose your own adventure. This is what happens in the late innings of cycle. Data comes in very mixed. And so depending on what side of the story you're on, you can find data points to justify both narratives. And I think that's what makes it really challenging in terms of the dynamic here. But we do think inflation drivers continue to be sticky. We do think growth is still hanging in there. And so there certainly is plenty of ammo for the Fed to take another step if they feel like it's the right time to do it in September.
So speaking of what side of the story, I feel like we're coming up with a new phrase for WWJD in the moment. If you'll excuse me, what would Jerome Powell do? Jay Powell. What side of the story do you hang your hat on potentially happening, especially when we look out towards September? They did leave the door open for another hike. Again, data dependent. What would, if you were a betting woman, what would you place your odds on?
I would bet that they take another step to hike rates and tighten policy, but it's entirely contingent on the trajectory of inflation. We saw a reacceleration in the July data. If that continues even modestly, we're not at the Fed's long-term target. And so I think there is justification for them to take another step, but we got to be getting to the end of the line here. I mean, the lagged effects of all of the policy tightening that they've done has still not really flown through the economy yet. And so it is going to be a really important story for the second half, even if they take one more step in September.
Amanda, the movement that we've seen in the bond markets, yields, the 10-year yield surging last week, pulling back just a bit today, but still well above that 4% level. When you're looking at this from an investment perspective, the risk that this poses to equities, what is the bond market signaling at this point to you?
Bond market signaling a hard landing. So equity market still delusional. I've been saying this all year, technical term for you. Equity market totally focused on no landing. The Fed is effectively pulling off mission impossible and getting inflation under control without tipping us into recession. Bond market telling a very different story. All of it is really aligning towards a harder landing, aka recessionary scenario. And what we've seen in terms of short-term yields, it really shows up to us as kind of that bear steepener in terms of the move in the yield curve. And that usually is one of the classic kind of final telltale signs of tipping into recession. So bond market's still very orderly, but I think very much lining up towards that recession looming large later this year.
So what's the playbook if there is a hard landing? I mean, and because you think about the perspective, it's not just so sure, kind of caution may be out the window when it comes to equities. But there were indications that it may be a soft landing, and there are calls for a mild recession. What's the playbook just to balance all of this out? Because we don't know.
Well, we're in the soft landing camp, as I said, and so we define that as a down 1 to 2% in terms of GDP decline. So it's not the catastrophic recession that we saw in the financial crisis, and certainly not at the onset of the pandemic. They don't all have to be that magnitude or that catastrophic in nature. And so from our perspective, we're definitely running more of a defensive playbook. But what's different about this time is that we're encouraging our investors to stay very much invested, not pulling the ripcord and raising a ton of cash. We're trying to stay very well diversified, trying to focus on long-term strategic targets, lean very much into quality, both on the equity side of the equation and also in the fixed income markets, dialing back a lot of that below investment grade exposure. Investors just aren't getting paid to take on that level of risk at these levels.
All right, we will continue to watch the space. Thank you, Amanda Agati, PNC Asset Management Group Chief Investment Officer. Thanks, Amanda.
Thank you.
All right, we're just getting started here on Yahoo Finance Live. Coming up, financial stocks have been hit today amid the latest U.S. banking downgrade. Could we be in store for another crisis? We're breaking down the move on the other side. Plus, Microsoft and Activision Blizzard have announced a new deal, but is it enough to get the $69 billion bid past UK regulators? And NVIDIA set to report earnings tomorrow before the bell. We're previewing everything you need to know ahead of the tech giant's second quarter results. That and much more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean
for you.
Keep it tuned into Yahoo Finance.
Bank stocks leading today's declines after S&P downgraded several lenders over liquidity concerns. The move coming on the heels of a similar downgrade by Moody's 2 weeks ago. And as a result, borrowing costs could get even higher from here. So here with more, we want to bring in Dick Beauvais, financial strategist at Odeon Capital Group. Dick, it's great to see you again. So first, just your reaction to this move by S&P. And of course, it follows a similar move by Moody's just 2 weeks ago.
Well, I think S&P kind of lost the ball here. They should have done this, a few months ago. The banking industry crisis began, last March, and it has not been alleviated or eased up in any way, shape, or form since then. And if people didn't believe it, by the time they saw the second quarter earnings of banks, they should have understood very clearly that this industry is undercapitalized at the current time, and that is the source of its problem.
And Dick, I want to ask you, to your point, this has kind of been simmering on the back burner for a while now. Is there the potential for systemic risks that we're not seeing right now?
Well, I mean, the systemic risk I think you're looking for or wondering about, is there a large amount of loan losses out there somewhere? I guess people are looking at the commercial real estate industry. I don't think so. I think that the issue here is that the Federal Reserve increased interest rates. Now, everybody knows if interest rates go up, the value of financial assets go down. But do they really know that? Because if you take a look at the banking industry, since 93% of their assets are financial in nature, the balance sheets of the banks have gone down, a step by step every time the Fed increases interest rates. And the decline in assets has now been so great, if you subtract it from the equity of these companies. In other words, if assets go from $100 to $80, you got to take that $20 off of equity. You'll find that most banks in the United States are struggling to maintain their common equity to asset ratios if you use fair value accounting, which of course the banks don't use. Specific example, Bank of America. They've got a securities portfolio called held to maturity. They show that security portfolio on their balance sheet at X number of dollars. If they fair valued that balance sheet, those securities, they would have showed that they've overstated the number by $109 billion. If you take a look at their home mortgage portfolio, the yield on that home mortgage portfolio is 3.40%, and it's about a $265 billion portfolio. That's not worth, par value. It's worth substantially below par value. But Bank of America doesn't show what the true value of that mortgage portfolio is. Now, I don't want to pick on Bank of America solely, because that's true of the banking industry overall. Now, if you're a regulator, you're taking a look at the numbers which are coming in from these banks, and you're saying, my goodness, they don't have equity, or that the equity ratios are nowhere near what they should be. So the Federal Reserve, the FDIC, the Office of the Comptroller of the Currency get together, and they issue this 1,083-page report, which is out for comment at the moment. And the bottom line of that report is, hey, guys, you're going to have to put more equity in your company, because on a fair value basis, the equity is just not there. Now, why should people go out and buy stocks in companies where the balance sheet that you see, that you get in your mailbox, is not the true balance sheet of the company? They don't do it, and they won't do it, because banks are simply not stating what the true value of their equity is, what the true value of their assets are, what the true value of their equity is.
So then, Dick, given all that, the fact that obviously, like you just said, regulators proposing higher capital requirements for banks of the $100 billion or more in assets, and then you take into account this higher for longer environment that it sounds like we are going to be in for quite some time, how much worse could it potentially get then for banks?
Well, I think, from an earnings standpoint, I don't believe that you're going to see reasonable earnings coming out of these banks for the next 2 quarters. I think in the first quarter, when the comment period is over for this 1,083-page document, you will see that the Fed will move, or these 3 agencies will move with alacrity to basically force these banks to increase their equity. Now, the banks have 2 options, because they know what I'm telling you very, very clearly, right? So they have two options. Do they go out, increase the rate that they pay on deposits, bring in more deposits, take that money, make more loans, or do they say, this is crazy, we're going to shrink our balance sheet, we're going to get rid of loans, we're not going to make as many loans, we're not going to fight hard to get those deposits, and when we shrink our balance sheet, the Fed will not come after us to increase the amount of equity that we should have in the institution. So now you have to stop and think, well, what does that mean for the economy? If the banks, pull back in lending, which I'll guarantee you they're going to do. You can take a look at Truist or U.S. Bancorp or Comerica or, a number of other Regions Financial, a number of other banks which, are already in process of doing that. Fifth Third, that's, specifically stated it, publicly. If the banks are going to pull back from lending, who's going to lend money to the economy? Remember, the banks have $23 trillion in assets. If they pull back, someone has to replace them. Who is that going to be? So it's going to be non-bank companies.
So, Dick, I want to ask you, when you're thinking about this kind of persistent inflation, it's really a double-edged sword when it comes to the banks. It's great in terms of it's great in terms of earnings, right? But it also has a kind of a negative side. So who is your pick when you're kind of balancing out this level of persistent inflation that we have in this high interest rate environment?
Well, I'll give you some names, but of companies that I like because they're well-managed banks. But I don't think that the stock prices of those companies are going to run up, tomorrow or maybe over the next 6 months. But I like Citigroup here because I think that, if you take a look at the balance sheet of Citigroup, essentially what you see is the market cap of Citigroup is only 25% of the cash on Citigroup's balance sheet. You have to say, how can that happen? In other words, the Citigroup is selling at 41% of its book value, but, its book value is even well below the cash in the bank. So I think from a structural standpoint, Citigroup has been oversold. I like Fifth Third because I think that the management there has a very clear view of what is going on in the economy. I think that they have, structured their balance sheet to take most of the impact from the increase in interest rates, and that's already been worked into the balance sheet. If bank stocks are going to go up, JP Morgan is going to go up. If bank stocks don't go up, JP Morgan may still go up. Remember, banking companies, if you take a look at the prices of these companies today, and we look at the prices of 105 of them, almost 90% of them are down in price over the past 5 years. In other words, bank stocks have continually dropped. And the reason that they've dropped is because of mismanagement of capital. These banks that I just mentioned, in this 5-year period, bought back $400 billion in stock. That is the most obscene thing that they could have ever done, because that $400 billion did not buy them any increase in stock price. The stock prices are all down. What did they do? What it did was they basically took $400 billion off their balance sheet, and that lost 1% of their earnings. But if they kept it on their balance sheet and they leveraged it 11-to-1, which they leveraged their equity at, that's $4.4 trillion that could have been working for banks at the present time that isn't there, because they decided to go to the top of their buildings and throw cash off the top of the building. So the net effect is they're to blame for a good portion of the reason as to why these stocks are doing so poorly at the present time. Managements need to be changed. Boards of directors need to be changed. They can't do things like that.
Well, Dick Beauvais, it's always great to get your perspective. You have to join us again more so we could get maybe some of the companies that you are going to continue to avoid within the space, given all those challenges. Dick Beauvais of Odeon Capital Group, thanks so much.
Thank you.
All right, Microsoft announcing a new deal today to get its $69 billion bid for Activision Blizzard past UK regulators. Yahoo Finance's Dan Howley and Alexis Keenan are here to break down the story. Dan, let's start with you. So talk to us about what's in this refreshed deal.
Yeah, so the deal basically is separate from what's going on in the EU, and what this calls for is for rival Ubisoft to get access to Activision Blizzard's games in the cloud. So it doesn't have to do with the console specifically. It's about cloud gaming, and that would seem to be the UK's biggest concern. Now, what that means is that they would be licensed to Ubisoft. They would have access to Activision Blizzard's titles, their exclusives, and then Microsoft and others would be able to license it from there. Ubisoft does have its own cloud platform, but it's not as big as Microsoft's. And so now we're going to see Ubisoft essentially relicense things back to Microsoft after they pay Microsoft to get access to them. So it's kind of this weird circular logic going on here. But at the end of the day, Microsoft and Activision Blizzard seem to think that it'll satisfy regulators in the UK.
What do you think, Alexis? Do you think it's going to satisfy regulators?
That is a maybe right now. Now, this could end the global challenges that have been brought against this deal. But that just leaves the U.S. as a big question mark here, because now the UK is the only country left still challenging this accord after the U.S. had withdrawn its FTC litigation. That one was retracted by the FTC after an appellate court in the United States said it would not pause the deal, so it doesn't have the legal authority to stop it. But look, that doesn't mean that the FTC can't still go after this deal, can't challenge it. That brings in the DOJ too. They have the right to bring a suit. And look, these antitrust actions, they can be brought after even a deal is closed, so it may make sense for Microsoft and Activision to get the blessing of the U.S. authorities, but right now that's not in play. We've reached out to the FTC. They are not commenting on whether or not this UK sort of re-proposal will change its thinking along these lines. So far, we have 40 countries approximately that have okayed this deal. So yeah, leaving the big question mark here in the US.
All right, another question mark, gamers. Dan, we haven't talked about them. What does this mean for them?
Yeah, it could be a good thing for gamers, because part of this means that Sony will also get access to these Activision Blizzard titles through Ubisoft. And again, this is it's just, a wild kind of roundabout way of getting over the UK's issues. But Sony players would be able to get access to them. NVIDIA players would be able to get access to them. And this is all via the cloud. So it just means that there would be more choice for gamers to get access to these Activision Blizzard games. It also means that mobile gamers would likely get more access. And I think that's really where Microsoft is trying to head here. Mobile gaming is growing faster. It also is an area where gamers who don't have high-end PCs, don't have even regular PCs, rely on their smartphone, they can get access to these high-end games through Microsoft's Game Pass. And so that's really kind of where the idea for this goes for Microsoft. Get more people hooked through mobile. Sony doesn't really do that. Ubisoft doesn't really do that. NVIDIA can do that. Any of these services can do that, but Microsoft is really focusing on it. And that's kind of the end-all be-all for them with this deal. So I think that, yes, it's very good for consumers across the board if they're able to access these games from the service of their choice. But then for Microsoft, it also helps to preserve that mobile element that's so important to them.
Well, of course, I know the two of you are going to be tracking this every move and seeing whether or not how this all plays out with regulators. We look forward to continuing this conversation. All right, Dan and Alexis, thanks. Well, coming up next, the number of U.S. tech startups down big over the last year as funding for early stage companies is declining. We're going to talk the state of VC on the other side.
Welcome back. The major earnings report everyone is waiting for this week, NVIDIA. The expectations are sky high, and Jared Blickery is on the floor of the New York Stock Exchange with more. Jared, take it away.
All right, well, let's go to the Wi-Fi Interactive. I've cooked up an interesting graphic for us. Actually borrowed this one from Statista, and this has the largest single-day market cap gains ever. And if you'll note, the biggest one is Apple here. In fact, Apple has two of these. NVIDIA is down the line, 184 billion. That was the last earnings report in late May, and that's what all of the action and attention is about here. But back to that $191 billion gain in November of last year, that wasn't even on an earnings report. That was just a day when CPI, consumer price inflation, came in below expectations. So maybe we're just going in the right direction there. A lot of these other ones, these big one-day gains, are earnings stories. Here's Amazon, 191 billion in February of 2022. Here's Apple in January of 2022. Shortly after it reached what was then a record high, not knowing, I guess market participants not expecting that we would fall into a bear market shortly thereafter. Microsoft in March of 2020, that was at the pandemic lows. That was when we were experiencing a lot of volatility. And then Tesla in January 3rd of 2022, it announced record deliveries for the prior year. And so these are just some historic moments that are giving options traders and traders in NVIDIA some kind of expectation about what they might expect tomorrow. Before I move on, I just want to show you how concentrated the market remains. This is the 2023 S&P 500 market cap gains. This big purple column right here, almost $5 trillion. That's a market cap gain of the entire S&P 500, very close to the Nasdaq 100, by the way. And that's because most of the gains are just have been done by these seven, the so-called Magnificent Seven stocks. NVIDIA is a leader down here with 767 billion. Then we have Apple, Microsoft, Amazon, Alphabet, Meta, Tesla. List goes on. But NVIDIA is now the leader, up over 200%. And let's go back to our, this is actually our 10-year T-note yield. That is relevant, but we're not going to get to that right now. Just want to show you the year-to-date totals here. So NVIDIA up 211%. It's going to be difficult to match anything like we saw last time in May, which was 184 billion. But options traders are betting that it's going to be an about 11% move tomorrow after the bell. And you can bet we're going to be bringing that to you and everybody else live here at Yahoo Finance.
All right, Professor Jared, thanks so much.
It has been a tough year for startups looking to raise money. Investors are getting pickier. Funding for early stage startups is declining. It fell by about half in the second quarter of the year compared to just about a year ago. That's according to the latest numbers from PitchBook. Here for a little bit more analysis, we want to bring in Kyle Stanford, lead VC analyst at PitchBook. Kyle, it's good to see you. So just paint a broad picture for us just about what the current VC landscape looks like right now. The fact that so many venture capitalists are pulling back on their funding, what position that leaves the startups in?
Yeah, really, the startups are in a difficult position, right? I think when we talk about what's going on in the market, there's 51,000 private VC-backed companies right now. And then there's also, like you said, maybe about half as much capital. And so these companies are trying to find a way to move forward. There's a lot of sectors that are very concentrated with multiple, growing, fast-growing companies. So it's really difficult to, pick and choose the best in each one. And at the top of the market, like even though, ARM and Instacart and some of these companies are talking about IPOs, there's a huge backlog. And so there's companies that are trying to fight and try to become efficient with their capital and make sure they're not going back to the equity markets if they don't need to. And investors, again, are still being smart with their money and trying to be efficient as well.
So where is the money going, where there is money being delivered? Is this, is this the fintech? Is this just, a pure tech play who has AI in its name, for instance? Kyle, where is the money actually going?
Right. AI has been the narrative of the market this year. And so there has been, some very large companies that are raising large deals, but I think this downturn has been spread across really all the sectors. When we talk about comparing to 2021, where every sector was raising record amounts of capital and record amounts of deals were getting done, every market, even AI, is still at a much slower pace in 2023. And so, strong companies in any market, whether that be pharma and biotech or climate tech, those companies are being able to find capital. It's the companies that are struggling for growth or struggling to hit the next benchmark in their category that are having trouble, and that is kind of going across the board today.
So Kyle, is that accelerating a wave of closures, and what does that closure rate look like?
So we actually haven't seen a rate of closures really increasing in the data. We have seen an increase in down rounds. Our last valuations report, about 15.2% of completed deals in Q2 were at a lower valuation than the company's previous round. And that's much significantly higher than what we saw a couple years ago. I think the low quarter we had was only 5% of deals closed. So, what we've looked at is there's actually so much capital going into the market in 2021. The companies have been able to find ways to continue lengthen their runway, whether through layoffs. Obviously, were a huge story the past year. Debt was very high in 2022. So these companies have actually been able to continue operations. So we haven't seen the large wave of closures yet. But as these down rounds pick up, that will filter into also companies that aren't able to raise. And so if we talk about when to think about closures, if nothing changes in the exit market, we would expect some closures probably now and toward the end of this year. We do expect a lot of kind of startup to startup M&A to kind of consolidate in some of these markets, and that's not always it's not a closure, but it's not necessarily the exit that many investors were hoping for.
And Kyle, when you say that only 5% of those deals closed, what was in those, or what was unique about those deals that got them across the finish line?
Yeah, so I think right now, as companies are able to show path to profitability, that's what investors are looking for. And so companies that are able to raise are very strong in revenue growth. They're very strong in path to profitability. And the 5% you mentioned, I think I was talking about down rounds, those are just like probably some companies that were really struggling to raise, but they were still finding some equity interest in the market in 2021. Now at 15.2%, down rounds are increasing. It's much more common. We do expect that number to tick up in Q3 and in Q4 until really the public market starts to let this capital cycle through the venture market.
So Kyle, what do you make of the success when it comes to Skims? And I bring this up because just, several weeks ago, they raised another $270 million in funding at a time when so many VCs are shying away from these direct-to-consumer brands. What is it about Skims' business model, or is it simply its affiliation with Kim Kardashian that's making it so successful at a very difficult time for startups?
Sure, I don't want to give one person too much credit, but obviously Kim Kardashian has done a great job with that brand and is very, very prominent in all markets, whether it be in direct-to-consumer in Skims or in reality TV. Everyone knows who Kim Kardashian is, right? But what that company has done is really built its brand on its main thesis, and it's really driven home to the potential customers of the what a great product it is, and it's they found a need in the market and really have helped fill that. So obviously Kim Kardashian has been a major boost to that company, but it's a great product and it's really found a need in the market.
Now worth $4 billion, pretty incredible there. All right, Kyle Stanford, great to get your insight. Thanks so much.
Always, thank you.
Coming up, China's economy is in trouble, but what does that mean for the oil market? We're going to break it all down when we come back. China's economy is in trouble, and that could have broader implications for the oil market. Crude prices hovering just around $80 a barrel as worry over the country struggling a recovery dims outlook for demand. Here with more is Yahoo Finance's Rick Newman. So, Rick, what does this mean for oil prices? Are they headed lower?
Hey, guys, I hope so. That could be the case. What's going on in China with the softening economy, the sort of collapse of the real estate market there, they've got all sorts of problems. China does not at all look like the economic superpower in the making that a lot of people have thought it was during the last 20 years. And every time I see that there are problems in the Chinese economy, what that means is China is such a big purchaser of oil that when the Chinese economy softens, that means China's oil purchases generally flatten out or even decline. That is actually happening now. And China is such a big player in the market that when their demand goes down, it's relief for everybody else who purchases oil. That is a pretty important story right now because we've seen oil prices and also gasoline prices here rising. We've got oil in the United States at around $80 a barrel. Gasoline prices are around $3.85 a gallon. I think when gasoline prices cross into $4 and there's a 4 at the beginning of that price, I think that freaks out drivers. That's a big problem for President Biden. If that were to happen, of course, the timing for him would be bad if we got $4 gas just as he's mounting his reelection campaign. So global oil markets are complex. There are a lot of factors. But when China stumbles and its economy slows down, that usually means we're going to get a break on oil and gasoline prices.
Rick, how long could that break potentially last year? We're talking about the pact, and you mentioned obviously it could be a huge break for President Biden if we do see gas prices lower. We know that's such an important issue here for voters. But when we talk about maybe the longer term effects of that, any idea what that would look like?
I mean, there's a lot going on in global energy markets. With part of it is the Russia's invasion of Ukraine, which has basically reshaped global energy flows. We, of course, have the move to green energy here in the United States and elsewhere. I guess I'd break it down into three things if you're looking at, let's say, a 12-month outlook. First, China's economy is not likely to recover anytime soon. They have been through many slowdowns, and they've been able to stimulate their way out of almost all of them for the last 25 years. This one seems different. There really are underlying problems, way too much debt in the Chinese economy, and that seems like it's likely to weigh down the Chinese economy for some time, think years rather than months. So that's good for falling oil prices. You've also got OPEC and OPEC Plus, including Russia. It's part of that broader OPEC Plus. They're trying to cut back on their supplies because they want to keep prices up. We've talked a lot before about Saudi Arabia drilling a little bit less. Russia's probably removing some oil from the market. And then the third big factor, U.S. production. I mean, people think we don't drill that much oil in the United States anymore. We actually drill a ton of oil. And the United States is now the world's biggest oil producer, and it looks as if we are going to hit new record highs for oil production here in the United States. It's not shooting up, it's inching up, but what's happened here is as oil prices stay elevated, drillers look at the market and they say, okay, we can make good profits at these prices, $60, $70, $80 or even higher. So we're seeing an increase in U.S. production. So all of those things combined are hopefully favorable for fairly ample supply. We've seen tight energy supplies the last couple of years, but that could ease for all those reasons.
All right, well, we will see oil closing today just above $80 a barrel. Rick, thanks.
Bye, guys.
Bye, Rick. All right, markets are waiting on Federal Reserve Chair Jerome Powell's Jackson Hole speech on Friday to see what kind of hints he may give on the future path of interest rates. One sector that's seeing the effects of rising rates, that's commercial real estate. With a look at the state of commercial real estate, we have Kathy Cunningham, Commercial Observer Executive Editor. Kathy, it's great to chat with you today. So first, I want to kind of set the stage. So you and I last talked in the spring about the state of commercial real estate. We've since had a hike, and we don't know what's to come in September in terms of the path of interest rates. So talk to us about where the state of commercial real estate stands right now.
Well, I think there's a lot of anxiety when it comes to what might happen at the September 19th meeting in terms of the Fed rate hikes. There was a lot of hope that the Fed would pause interest rate hikes last month. They did not do that. So I think what the commercial real estate industry is really kind of grappling with just now is that so much is impacted by interest rates. So higher borrowing costs are given, but also, increased cap rates, decline in property values, and a lot of really, stress when it comes to transactions. So we've seen transaction volume really muted for that reason.
Kathy, what does the price declines potentially look like if, in fact, we do see the Fed hike again?
I think it's not pretty, actually. And I think that, especially we've seen some asset classes, specifically multifamily, industrial, really kind of insulated from some of the cap rate increases and some of the stress when it comes to interest rates. But when you look at some of the out of favor asset classes, such as office, retail, these are the most heavily impacted. And I think so many borrowers, especially office owners, are really struggling with their properties just now when it comes to loans that are maturing, in need of refinances. And an increase in interest rates is going to be especially bad for those owners.
So, Kathy, is the worst still ahead then for office?
I fear it is. I do fear it is. From everything I'm hearing from my sources, and obviously we're very heavily dependent on our sources, what they're telling us, but things are not going to get better until interest rates stabilize, till there's some price discovery, and I think until a lot of the distress actually makes its way through the system when it comes to commercial real estate. A lot of my sources are expecting an uptick in distress in the fourth quarter, and that'll come from kind of forced property sales and also loan portfolio sales. And we're starting to see some of them slowly unravel now, but what I'm hearing is there's going to be a lot more of that in the fourth quarter, so plenty more distress to come, unfortunately.
So there is, obviously, we've talked about this too, the potential for more distress to come. And we've talked about the worries with regard to the office sector and even the potential for these banks to have to offload some of these loans on their books. But what about the bright spots? One thing that we are hearing is about, say, some strength in retail. What are you hearing there?
We definitely are seeing a lot of strength in retail, and it's been a really refreshing change, I have to say. During the pandemic, the past few years, multifamily and industrial have really been the two darlings of the asset classes. But the last, I would say probably 6 months or so, we've seen a lot of investors, a lot of lenders gravitate slowly back to retail. And I think there's coming from a few different reasons. I think they want diversification in their portfolios. I think there's a slight return to brick and mortar retail and experiential retail also. So whereas retail was once the redheaded stepchild of asset classes, I think that's no longer the case. I think it's firmly office now that is the out of favor asset class, and retail is making something of a comeback, which can only be good for commercial real estate.
Kathy, when it comes to city versus suburbs, we talk about it a lot when it comes to office space. How does that comparison work when it comes to retail now that more people are working from home? Are you seeing higher demand for some of those retail locations in the suburbs than we were pre-pandemic?
I think we definitely are. And I think, again, the emphasis is really on the experiential side of things. I think if you can bring shoppers into a mall or into a shopping location where there's something else to do apart from just shop, I think that's definitely something that works in your favor. I think that there's no doubt that we have seen some of the big cities, especially downtowns, the retail locations there have been heavily impacted. But like I said, I think there has been slight recovery there. I think, though, in general, when it comes to the cities, the downtowns continue to be a big concern overall. Just, in terms of you look at the office product there, the lack of people in their offices, or if they're there a few days a week, they're not there consistently. And I think that gradually is creating more and more stress on cities' downtowns in general.
And then, Kathy, what are you expecting to see in terms of consolidation in commercial real estate, especially when you think about some of the distress that's coming? I'm sure some people will be looking for deals.
Oh, absolutely. I think, from everybody I was speaking with just now, and I speak with, investors, lenders, family offices, big investment firms, really runs the gamut. I think there definitely is talk of, there might be some consolidation for sure. I think the bulk of what I hear about is actually not at the corporate level, but more of the individual asset level, where people are expecting to get some good deals on property purchases coming toward the end of the year, and also CRE debt, so commercial real estate debt. So I think if people are, have the capacity to buy and to deploy capital into either real assets or debt, it's a really good place for them to be right now. It's a good chance for them to really enter the commercial real estate industry at a low basis, get their hands on some pretty decent properties, some pretty decent loan positions also when it comes to commercial real estate. So I think there's a lot of hope that if you're somebody who's been sitting on the sidelines for a long time with capital to deploy, now is a good time to do it.
All right, Kathy Cunningham of Commercial Observer, we always appreciate your time.
Thank you so much.
Thank you. Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and top trending tickers. Stay tuned.
The closing bell on Wall Street. Let's do a check-in on how the market settled for the day. The Dow and the S&P both closing below the flat line. The S&P falling below 4,400. You have the Dow off just around 174 points. Nasdaq ending the day, just barely ending the day in the green there, up less than 0.1%. When you take a look at the sector action today, real estate, utilities among some of the outperformers here. Financials, the underperformer, with XLF closing off just about 1%. Let's check in on some of the biggest movers of the day. And we got to start with the move lower in financials. Bank stocks taking a hit after S&P Global downgraded several lenders over liquidity concerns. Now, this comes on the heels of a similar move made by Moody's just about 2 weeks ago. And Diane, when it comes to why S&P downgraded several banks here, a lot of it was over liquidity concerns. Associated Bank and Valley National both cut on funding risks and higher reliance on brokered deposits here. UMB and Comerica, they were cut on deposit outflows and the risk of higher rates. We know that this is a very challenging environment right now for many of these banks, specifically also, more specifically, I should say, the regionals.
Right, and KeyCorp also on that list, the issue that S&P bringing up about constrained profitability there. Again, just those worries about deposit outflows. And it's so funny when we think about how the regional bank conversation had kind of gone to the back burner, then it came back to the surface again recently. And so S&P following in the footstep of its peers in downgrading and putting some banks on watch. But what was interesting to notice is just the impact also across the financials, across the banking sector. Even the big banks took a leg down today. When you think about JP Morgan Chase, Bank of America, both down 2% on the day. Of course, not as much as the regionals. We're seeing them all down between 3 and 4% on the day. You know, and obviously the impact makes sense there. But, you know, when we talk to analysts about, you know, they're expecting, of course, the big banks to weather any potential storm, right?
Yeah, well, Dick Beauvais saying that this move should have been done months ago. Right. When we talk about the challenging economic landscape right now, the higher borrowing costs, what exactly that means here for banks who are already struggling just to keep those deposit levels high, especially many of those regionals. And then you take into account the proposal here in terms of raising capital requirements, what that's going to do here to some of those smaller lenders. I also want to point out what S&P said about two other banks, S&T Bank and also River City Bank, and they have a negative outlook from Stable here, citing the high commercial real estate exposure, which is just another headwind here for this group of stocks.
Right. And on the opposite of headwinds, tailwinds, if you will, shares of NVIDIA finishing the day strong, actually under a little bit of pressure, I guess, getting out in front of the earnings. It is leading the earnings story this week, though. The company set to report its second quarter results after the bell on Wednesday. Want to know it's actually after the bell. The bar is being set high after NVIDIA smashed analyst expectations last quarter. You'll recall when they guided on revenue, they guided for $11 billion, right? And that exceeded estimates by billions, not, you know, by like some $4 billion in terms of estimates. And now you have analysts ratcheting up expectations, say they're going to blow past that, right?
Yeah, and we'll see whether or not NVIDIA lives up to the hype. And so much is riding on this report. We were talking to Amanda Gotti last hour, just the fact that you have to remember, NVIDIA is one of the biggest reasons, the biggest reason why we've seen this massive run up in some of these AI names. They have really set the pace. They are by far the leader in this space when you take into account the 220% rally that we've seen in shares since the start of the year. If we see a disappointment from NVIDIA tomorrow, that could have massive implications for the broader market, could really put pressure across not only these AI names, but the tech sector, when you also especially take into account the higher interest rate environment and the fact that that is challenging for a lot of these names within the growth sector. But when it comes to some of the movement that we could see on the heels of these reports, the options market bracing for a move of nearly 10% following the results tomorrow night. So we'll see whether or not NVIDIA is able to live up to those high expectations.
They're far and away the leader, though. So there is, you know, they can kind of rest assured in that. And, you know, while other people are kind of talking about building up their AI portfolio, NVIDIA is actually doing it, right?
It is. So, I don't know if that's going to be enough, though, for investors if they fall short tomorrow. We'll see. All right, Dick's Sporting Goods stock tumbling today after the company missed on earnings and also said that organized retail crime is cutting into profits, and they expect it to continue to cut into profits the second half of the year. Yahoo Finance's Josh Schaefer is here with more. Josh, a loss of 24% today.
Big loss in the stock, and I think a lot of that is because Dick's Sporting Goods, we've heard from a lot of retail companies, right, talking about organized retail crime, talking about what they call shrink and how that's impacted their inventories and impacted their profits. but we had never heard that really from Dick's Sporting Goods. Multiple Wall Street analysts highlighting going back years now that has not been something that Dick's Sporting Goods has talked a lot about in the past. So I want to just play for you here what management had to say on the call earlier this morning.
The biggest impact in terms of the surprise for Q2 primarily came from shrink. We thought we had adequately reserved for it. However, the number of incidents and the organized retail crime impact came in significantly higher than we anticipated, and that impacted our Q2 results as well.
So higher than Dick's Sporting Goods had anticipated, so they moved down their overall full-year outlook here, too, for earnings, and that's probably the main thing that's driving the stock. So they moved it down to a range of $11.50 to $12.30 per share. That was from, they had initially guided for $12.90 to $13.80, so a pretty big move downward there. But the other thing that was interesting from the call, when you think about the overall gross margin pressure here they're talking about, they said only a third of it was from shrink. They also said 2/3 of it was not shrink related and was actually more of a strategic thing. They had some pressures in their outdoor business this quarter, and they were trying to offload some of the outdoors business, and that seemed to be something that I was listening to the call live. Several analysts hung on that and kept asking questions. They were like, interesting, the outdoors business didn't do as good as you thought, and they sort of said, well, it's only a 7-week period. But I think that's going to be an interesting sector to watch for Dick's moving forward as other businesses have become more popular in the outdoor space. Think maybe an REI, which isn't a public company, but very successful in that area.
It's so interesting because, yes, to your point about it just being a third of the problem, not that it's not a problem, it's obviously a big problem, but I am surprised to hear that, and I'm not surprised to hear the analysts went after that point. When you think about the impact of shrink and organized crime, though, we're seeing this. So I was surprised to hear about this at Dick's, right? Because we've heard about this at Nordstrom. But like kind of paint a picture for us about how much of a problem this has become for the retailers.
Yeah, I mean, Brooke DePalma did a great story that's up on our website right now highlighting what we heard last week, right? You had Target, Walmart, Home Depot, all mention it. They all mentioned it to some extent. Target's been mentioning it for well over a year now. They at one point last year said that they thought they lost $400 million in the course of the year in profits just due to shrink. But you've also heard about it at Dollar Tree, so in the dollar stores. Rite Aid has said it. So it's really kind of all over the place. And that's where it's interesting, where you wonder how much of it is, like, where is it sort of spreading and how does it stop? I think it seems like not a lot of retailers have a very clear answer on that, other than it's just, we need to make it stop, seems to be the general take, but it doesn't seem like there's been a lot of solutions. I did see one thing out there that someone was pointing to TJX actually hasn't had as big of a problem there, and they feel like they've had a good police presence in stores. Interesting.
Also, the pricing is pretty good.
Right, and maybe people just feel like they're getting deals.
But you're real. I don't need to
But when you look at some of the shrinkage, at least in some of these more staple plays, when it comes to it, it's a lot of times it's on things that people need, essentials. It's deodorant, it's shampoo, it's conditioner. It's things that you wouldn't necessarily associate with a nice to have. It's more of a must have, which also I think just brings it back to the current time right now, the tough economic environment, the fact that people simply don't have what they need to be spending on some of these goods.
Yeah, if you're stealing necessities, I mean, that's never a good sign just for the overall economy, right? And how we should feel about things. But it has been interesting, too, when you think Nike's had the problem, right? But people are stealing Nike shoes so they can resell them. And I think that's probably closer to what a Dick's Sporting Goods would fall under as far as people are probably stealing some nice items, maybe a nice baseball bat or something. I don't know. But they have high value items in Dick's Sporting Goods, right, that people want.
One of the things that stood out to me in terms of Dick's earnings release that they're doing, and they kind of pinged it on shrink, but it's clear it may be due to their, their outdoor business, is business optimization, which is code for layoffs, right? So you wonder if some retailers would start taking actions like that to address it, which is kind of a sad situation when you think about that some, employees could be affected by that when it's not their fault.
Well, a counter argument, though, could be that some people have pointed out to retail theft is a lot of companies have gotten rid of employees and they have that self-checkout now, right? And that could also be leading to theft. So you wonder which way it sides, right? I think you can make an argument both ways, but I thought that that's something that's interesting, too, is a lot of companies tried to reduce headcount, give us our option to check out on our own, and then they don't really pay attention to what you're checking out and what you're not checking out.
Right. All right, we'll put a pin in that conversation. We will clearly be talking about that more. Josh Schaefer, thanks so much. All right, coming up, the cost of new vehicles in July was up 3.5% from a year ago. But as inflation is easing, why are auto prices rising? We discussed that. That's on the other side. Monterey Pebble Beach Car Week wrapping up, and it was a blockbuster for luxury automakers. Concerns over a consumer slowdown, not an issue there. Auction sales topping $400 million in the week. Prad Subramanian is here with the details. Looked like it was a fun adventure.
Yeah, a lot going on. They're very busy, chaotic, fun, but mostly just a lot of car action. A lot of, these are the biggest aficionados in the world go there to see these cars for the week. So, when you think of Monterey, you think about Rolls-Royce, right? The 120-year-old car maker, synonymous with luxury, champagne, Grey Poupon mustard, all that stuff. So, but all joking aside, we do get a chance to see them there, and their CEO, Torsten Müller-Ötvös, who is sort of crushing it at the top of the luxury game there with Rolls-Royce. And he has his pulse on the finger of that consumer. And it's always good to talk to him about what's going on in the world and what he's seeing in the global luxury market. And there's a little tinge of concern there. So here's Torsten on that.
I mean, what we see obviously currently is that the world is slightly different than it used to be a year ago. Not a big surprise. And I would also say that these very exuberant demand patterns for luxury goods that we have all seen right after the pandemic is sort of coming to an end and is normalizing. And we see that worldwide. That is not only true here for the United States, but also for Europe, for Asia. You also might have seen that in China there is a bit of worries around the economic development of the country, so that obviously also puzzles some of our clients.
So while he did say that things are normalizing, and the wait list for a Rolls-Royce is over a year right now, the fact that he was called out China and had some talk about how things are sort of changing, the world's changing, is a little slight concern there, but I don't think for Rolls at this point that should be a concern for investors of BMW who own the company.
Yeah, at least right now. Praz, there was lots of talk I saw on the internet, across social media, about this new car that Rolls-Royce is debuting or plans for, right? And it's got one heck of a price tag.
Yeah. So you saw that actually there, standing behind me was the Rolls-Royce drop-tail Roadster. It's a two-seater that I haven't had a two-seater in over 100 years. This is a drop-tail version. It's a custom-built. Only 4 of these types will be made, and each one will have a story. So this one has a story. A couple commissioned this car. They're celebrating the 30th wedding anniversary, and it's called the Noir Rose, the Black Rose. It's called the Black Baccarat Rose. Never heard it before. It's like a very dark color rose. I guess maybe their favorite color. So this car has over 1,000 pieces of wood inlaid in it. It has a Audemars Piguet watch that sticks in the dash, and you can pop it out and wear it. It's a custom-made watch just for the car. So I did ask him about the fact that there's rumors that the car costs $25 million plus. Wow. And Torsten said to me, quote, "I think this is quite a good judgment. This is the ballpark."
Ballpark. Wow.
So 4 of these will be made, $25 million bucks, probably around that, if not more, for the Rolls-Royce Droptail.
It's my favorite color too, but for me, just pretty to look at.
Yeah.
I know. Wish I was one of those
right,
buyers
exactly,
of the
where
car
it's just
for
no big
25
deal.
Ballpark.
Or just get a ride in it, right? Yeah.
Right?
So, okay.
Great.
All right, Prad Subramanian, thank you.
Even as inflation starts to moderate, Americans are still paying a heck of a lot for certain items. The cost of new vehicles in July was up 3.5% from a year ago. And this year, there's only one new vehicle model that's selling for less than $20,000. Those higher payments are starting to pinch drivers. So here with a closer look at this, Wall Street Journal reporter Ben Foldy. Ben, it's good to see you. You had a piece in the Journal last week highlighting some of the troubles here that car buyers are facing given the higher costs of vehicles today. What are we seeing as a result?
Yeah, I think for those of us who can't afford $25 million Rolls Royces, the payments are starting to pinch. I mean, both in used and new prices have kind of steadily gone up during the pandemic. And I guess actually they're kind of peaking now. I think your graphics showed that the month-on-month was actually down. So it seems like we're probably at the peak for new cars. But, for everybody who bought a car at the peak, a year ago or a year and a half ago, they're having to keep up with these payments. And the average monthly new car payment is $750, or it's around in that ballpark. And so as rates have gone up, even as prices have moderated a bit, now you're still paying a lot for your car, and people are struggling, I think. And what's interesting is that normally you see that struggling and kind of those delinquencies and stuff kind of tick up when you have problems in the job market, and obviously we don't have that yet. So I guess one of the questions is, how narrow is that kind of landing strip for the soft landing? If there is a recession and there are impacts on the job market, like, is there going to be kind of a hockey stick of distress in auto lending?
And so, Ben, I want to ask you, what did your reporting show you with regard to where the distress is kind of starting to pile up? I mean, we have seen these prices go higher. I was surprised to see that there was only one car, like one vehicle below that. Like I was like, well, let me look up a Honda Civic and see what that's going for now. And you're right, it is higher than $20,000. So with that distress piling up, what does your reporting show you in terms of who you talk to about where it's affecting Americans?
Yeah, I think it's definitely more noticeable in subprime, which I think people with below, I think 660 is the cut for subprime. So people with kind of more subpar credit. And I think that makes sense for a number of reasons. I mean, those are kind of riskier borrowers to start. There's kind of higher expectations for loss, but then you also, if you kind of make some assumptions, let's say, but so subprime buyers are probably more likely to rent than to buy. So they aren't, on refinanced mortgages paying, 1% or whatever. And rent actually has gone up quite a bit during the pandemic. So that's been a stress that doesn't necessarily show up in debt service coverage ratios. And that one of the analysts I was speaking to was talking about that, is that there's kind of a hidden rent impact there. One of the other things that I think we should look for in the coming months is and again, this goes back to kind of subprime and younger borrowers, is the resumption of student loan payments, which will, there's been this holiday on student loan debt for, I guess, almost 3 years, and that's coming to an end at the end of the month. And one of the factors that TransUnion, the credit scoring agency, pointed out in their seminar on this was that of consumers that have outstanding student debt, I think more than 34% of them took on a new auto loan during the pandemic. And again, so they take on that new loan while their student payment is frozen, but that loan is also, they're basically buying in the peak of the market for either used or new. So their payment's going to, if the payment shock of the student loan comes back, and they're already kind of struggling to keep up, which I think we can see in the delinquency data, there could be kind of more distress ahead.
So, Ben, what do you think this ultimately means for the car makers? Because up until this point, they've been able to pass along higher prices. They've been able to focus on the higher end cars, the luxury cars, because people were buying them. Now that seems to have shifted, right? Consumers are under even more pressure than they had been in prior months. So do you think we'll ultimately see car makers being forced here to lower their prices?
I think there's definitely an opening. I think there's openings for kind of the more budget manufacturers, and you've seen kind of foreign automakers tend to kind of fill that space where it's basically impossible to get an American-made sedan at this point. And so I think there's an opportunity for that. It's hard to say. I mean, without the distress of kind of a broader macroeconomic slowdown, it's possible that this could kind of be the new normal, but I have trouble seeing that as a long-term future. I think profitability will be compressed at some point.
And Ben, I want to ask you, what did your reporting show you in terms of trends with regard to used car trade-ins? Because you remember there was a period of time that we'd really never seen before where you could get more for your used vehicle than what you bought it for. Has that trend decelerated from what you've seen in your reporting?
Yeah, so if you the Manheim Index, which tracks used car value, has come back to earth. I mean, it's still still very elevated relative to what it was in 2019, pre-pandemic. But I think you point to an interesting question, and actually alludes to the last one too, which is that where this is going to bite down the road is, if you bought your used car in 2022, in the first half of 2022, again, you bought at the peak of the market, you're going to go underwater on that loan much quicker, because the depreciation of that used car is going to be steeper, and that's going to make it more obnoxious to pay your loan, but B, it's also going to cut into your trade-in value. So that's actually one place where the where the automakers may get hit kind of down the line is that, you know, people are going to have less money to play with the next time they need a car, because whatever they bought at a much higher rate than a higher rate and higher price than whatever they're getting in the trade-in. So that's going to bite back.
Certainly are starting to see consumers under more and more pressure with their auto loans. All right, Ben Foldy of the Wall Street Journal. Thanks.
Thank you.
Coming up, we are checking in on some of the top trending stories of the day. Josh Schaefer, Ali Canal standing by with what we're watching. Guys, what do you have?
Hey, Shauna. Well, we know that Bud Light sales are continuing to fizzle.
We'll bring you what beer brand just surpassed Bud Light for sales this year next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer, Praz Supermanian. And Praz, I know you're watching booze, our favorite topic here.
Yes, I am the new Bud Light reporter, apparently, but new data. There's a new king of beer sales here. So new data shows that Bud Light has been dethroned by Modelo. This is data as of this year of date. So right now we're seeing that Modelo has 8.34% market share in the U.S. at retail locations like stores and bodegas, and Bud Light's at 8.28%. Now, that's a slight sort of difference there, but it's the first time that Modelo has taken over for Bud and potentially for the whole year. We'll see. But Bud has been the king for the last 2 decades. So it's kind of, sort of a dethroning here, a new guard. The guard is changing here. Josh, we've been following this story for a while now. We've been seeing that recent trends have been showing that Modelo has been winning in July and August and June. So we're not surprised it finally happened, but I think it's still kind of hard for Bud Light to see that actually happen.
To me, the most surprising thing is if you went back to April and you asked me to predict who would pass Bud Light if this was going to happen. I don't know about you guys. I would not have picked Modelo.
No.
I would have picked Coors or Miller Lite, right? And I don't know if Coors Light and Miller Lite are sort of sharing some of the market gain here because those beers taste a little bit more similar than Modelo does maybe to Bud Light. But I just found that I think that's the biggest takeaway for me here. It's just like I had no idea that Modelo was the next favorite beer in America to begin with.
Is that a light beer? Is it?
Yeah,
similar?
I mean, I think it tastes similar in some ways, right?
I don't think it's a light beer, right? I think it's like a very normal lager.
Yeah, I don't know what the calories are on it, which would be an interesting breakdown when you think about trends.
Larger point, you're absolutely right. I mean, who would have thought Modelo?
Yeah, I just like that was the biggest. I was like, I remember when it first happened in the monthly data back in June, I was like, Modelo, I wouldn't have thought of that. Yeah. I like a Modelo lime, not bad.
I mean, you're talking about trends, and I just think consumers, they want something different. I've said it before in this roundtable how I think Bud Light tastes like water. Like there's just no taste. Miller Lite, Coors Light, they're all the same to me. They just, maybe I'm just scarred from, college. Who knows? Yeah. But I do.
Well, that was Natty Light, and that tastes worse.
Oh, Natty Light, forget it. But yeah, and we're seeing liquor become more and more popular. That's gaining market share, just as ready-to-drink cocktails, those types of things. I think for convenience purposes, and also, I think about calories. I feel like people are choosing more wisely, I guess you could say.
Well, you referenced the liquor stats. That was from a Gallup poll out today, now saying 31% of people prefer liquor. That's above 29% responding and saying they prefer wine. Now, beer is still leading that with 37%.
I think because beer is easy.
But I think the tick up in liquor to me probably is a caloric intake thing, right? You can drink it neat, just on ice. If you drink the right kind of booze, there's really not that much sugar in it, right? Like, depending if you're trying to be weight conscious or however, dietary, right? You can do that with liquor, which is why I think you've also seen the ready to drink cocktails pick up too, right? And that seems to be, if you're Anheuser-Busch, maybe your solution to your problem here is, can you build some kind of RTD drink that gets really popular, or sort of get into that space, right?
I mean, I think just real quick, the wrinkle here for this story for me always has been the fact that I can't believe the boycott, the controversy, the people who are upset about Bud Light, that's lasted so long. I think that's the staying power of this potential boycott is sort of talking to me like, making me think about like other brands that could be a risk if they do something kind of, that alienates a big broad swath of their users.
Yeah, I think a lot of people out there just keep remembering things, right? People don't forget things sometimes maybe as quick as we think that they do.
Yeah, right.
And our friend Elon Musk is learning that on his current brand right now, X, formerly known as Twitter. Pross, that's the story I'm watching today. Elon was out tweeting yesterday, basically pitching journalists to start using X as, I guess, a quasi-Substack. He was like, post your stories on here. He said, if you're a journalist who wants more freedom to write and a higher income, then publish directly on this platform. He also quote tweeted this tweet that you're seeing now on your screen that said, X is the place to be if you're a blogger, podcaster, writer, influencer, video creator.
Wow.
And then it was funny, Pross, you pointed this out to me, a couple of journalists quote tweeting Elon and saying, aren't you the guy that muted me on Spaces or kicked me off Spaces or whatever he did to journalists?
Got rid of the check marks.
It's like you haven't made friends with a lot of the Twitter creators and the people that love Twitter. And now you're realizing you kind of need to rely on them for your business to be successful.
Yeah, well, so as Ryan Mack, New York Times reporter, that he said, my dude, you actually subpoenaed me to run in my testimony for a lawsuit because I report on you. He also deplatformed Elon Musk's private jet guy. When that guy, he tried to deplatform him. So it's kind of rich for him to talk about bringing journalists on board when he's sort of been anti-journalists. But I totally get the larger point, though. We talked about before, bringing creators on to get that boost, juice up those numbers for these networks. But I got to ask, how much money can I get if I'm going to join something like Twitter? I know it's a rev share, but it can't be that much.
Well, I thought I was reading that X was actually giving creators more than they were getting on some of the other platforms, or maybe I'm confusing that with
like a percentage? Maybe you're right.
No, I think that's what they're trying to do, right? It gets the larger point of now it seems like if you're going to be at least trying to build a social media platform, maybe not at this point if you're Instagram. I don't know how much you're getting into this competition with people that post on X, because it's also video versus text, et cetera, right?
Well,
but you're just trying to get some of the creators' time. The creators are what bring people to the platform. It's the way you're going to make ad revenue money because you need more people to be on the platform. So it's sort of funny to see, to me it's funny to see Elon now in this circular nature having to come back to the table to the people that he's really sort of chastised before and saying,
hate you guys.
Actually, I need you. It's this whole Twitter story just playing out again, right?
For sure. And I think my problem is that you have to define what you are. Why should I go to X? What is the sole purpose of X, if there is one? Because I feel like
to be a podcaster or a blogger
yeah,
or a video
that
creator.
Feels different to me. Like, that is it YouTube?
Right.
Is it TikTok? They each have their specific need, and X.
So true.
I don't know if we
But
know
I
what
do
that
think
is.
it should just be Twitter. Well, Twitter was great.
Right.
Like
But
short little
it's
messages.
trying to be too many
But
things.
I don't, maybe I'm living in a vacuum here, but what Twitter was to me was a quasi news source, though. Right?
Totally.
It wasn't that, like, I don't think there were that many people that were using Twitter for pure entertainment the same way I might use TikTok and just scroll and
I
be
don't remember
entertained
seeing a
and
lot
not
of
see them
videos on Twitter.
I feel like Twitter was a lot of people posting news, right? A lot of the ESPN guys that got famous on through the sports stuff.
Sourcing, yeah.
Right, source, and then actually breaking news. So I can see why they want to actually appeal to journalists. It makes sense. We literally live in a vacuum on Twitter and have for years, right? We thought it was the most used platform ever. Then the numbers start coming out and you start looking at it close and you're like, wait, it's just me and other reporters on here retweeting each other.
True.
But I get why he's going the reporter route. You can sort of make it a mini Substack.
Yeah.
I just don't know if that's how it actually plays out and you make profits.
Right, and is it sustainable moving forward? Well, from creators to consumers, this is an interesting story. The RealReal, which is a luxury resale platform, it's noting how a lot of consumers are still buying the Gucci bags, they're still buying these luxury brands. However, they're looking for more value, so they're seeing more people gravitate towards, you know, a fair deal. So maybe they're going to purchase a bag that's in not great condition, or perhaps a cheaper price comparatively. So interesting to see that even the luxury consumer, they're trying to be a little more picky and going towards value. And that's coming, as we know, the consumer has been really resilient within this current macro environment too.
Demand for bags in, quote, fair conditions up 130%. That sounds like you're probably searching for a used bag, right?
Totally,
Still
and
in
that's
decent
what the
shape,
RealReal
right?
is.
And so I think that's just an interesting takeaway, right? You're seeing people look for something that is, quote, lightly used or in fair condition rather than new. I mean, if you're if you're feeling really good about things, you probably just get the new bag, right?
Well, the report says that fair is the lowest tier of quality on the RealReal. But hey, taking a quick step back here, it's the RealReal talking about how, hey, the shoppers are more savvy. Yeah, the RealReal is saying that, right? Because they want you to go shop on RealReal.
Totally.
But I think it echoes what LVMH said about a month ago. They're seeing a little bit of weakness, especially in the States and the high-end luxury consumer. Maybe they're trading down to the RealReal. Maybe they're trading down to Grail, things like that, where they can get good stuff that's used. I mean, I don't know much about that from a younger shopper point of view. The report mentioned Gen Z, millennials are into that kind of stuff, but I'm not sure. But I guess there's a trend here.
Totally, and there was this interesting graphic that was up about how lab-grown diamonds are becoming more of a thing, and basically that you could get, you know, a diamond that's half the cost of a mine diamond. I know people have hot takes about this, but
wow. Pras said we were out of his wheelhouse when talking about Gen Z shoppers. Lab-grown diamonds,
Oh, that's Gen X. Excuse me,
I
Gen
can't
X.
say I've done a lot of Googling. But I think it is interesting, the brands that people are interested in still too, right? That Gucci's still pop, like these brands.
They still want the high-end brands,
They still want the high-end brands. They just want it used. But a good overall sign, you would think, if you are the luxury brand, that your brand's still carrying the weight, right? If I only have $50, or $100, because it's probably not $50 for something used Gucci. You're still in the hundreds.
Oh,
you're still
yeah.
well
You're
used.
not $50.
You're still in the
even
you're still
used.
well in the hundreds.
I've been to a RealReal store. I was shocked at how expensive some of those things are, even used. So
real expensive.
Real expensive.
You know
and
go
oh no, I was just gonna say real expensive, like everything else.
Well, and they also have vintage watches, their resale watches, and this is
There you go. That's what you're looking for.
And this is not the same thing, but Rolex has their own CPO certified pre-owned program, and it's not because they want to like offer a cheaper product to somebody. They want to offer a product period to somebody. So maybe there's something there. Maybe you might see an LVMH do a little bit. We have a certified pre-owned area here. I don't know if these secondhand goods are so in desire.
In demand?
In demand.
Hey, I'm still fine going on Amazon and getting the dupes. So that's where I'll stay for now. But that is it for us here at the Roundtable. We'll see you back on the other side of this break.
Manufacturing sector showing signs of strength in the U.S. And one of the reasons is the transformation to cleaner sources of energy. Our own Brian Zazi sat down with the CEO of one company that's doing just that. Brian first asked Cummins Chair and CEO Jennifer Rumsey about the company's focus on hydrogen engines.
First, just as a reminder for those that aren't familiar with Cummins, we're an over 100-year-old company focused on providing power solutions for commercial and industrial applications. And we do see decarbonization as a growth opportunity for us in our businesses, which may be surprising to some for a company that's over 100 years old and got its start in diesel engines, that we do see the embrace and see the need to drive decarbonization as an opportunity for growth. But our strategy, which we call Destination Zero, is focused on doing just that, and doing that really through a dual path approach, which is advancing our engine-based solutions and improving CO2 from those solutions, as well as accelerating and innovating in zero emission solutions like fuel cells, battery, and electrolyzers in Accelera by Cummins, our zero emissions business.
Jennifer, I grew up seeing Cummins on the sides of trucks, and I'm very familiar with your engines. And as you mentioned, you're over a 100-year-old company. How do you change mindsets inside of Cummins to position for a future that in some respects you can't quite see yet?
Well, the history of Cummins is actually all about embracing change and the need to drive change to innovate and grow the company. So we've done that for my now more than 20-year career. First with NOx and particulate emissions and advancing our engines and growing our components business, which didn't exist 15 years ago, based on that innovation and that need. And so we're doing just that again. We're embracing this need for change, driving innovation, advocating for change that will enable our customers to continue to be successful. And they serve the heart of our economy, of course, commercial and industrial equipment, while also addressing a very real issue that our planet faces, which is climate change, and doing our part to contribute to positive change there.
We are well familiar with the story on what the automakers are doing. So they're rolling out electric vehicles at the same time. They're coming out with more hybrids, but their cash cow remains gas-powered engines for trucks and vehicles. What is the view inside of Cummins? Over the next decade, will you still be making diesel engines?
Yeah, so the short answer to that question is yes. It's important to realize that commercial and industrial applications are quite different than passenger cars. First of all, for many of us, you and I know included, we buy cars based on emotional buying choices.
That's me.
For our customers,
raising my hand,
they're
Jen.
making
That's me.
business decisions. Right, me too. Emotional decision on what car I buy. But our customers are making business decisions, right? They need to run equipment that will allow them to be profitable and successfully meet their business requirements. And so they're really interested in initial cost and total cost of ownership in these technologies. Second is there's a range of different applications. When you look across different commercial and industrial applications, from a bus to a pickup and delivery truck to a heavy-duty long-haul truck, a large mining truck, there's very different power, weight, range, and life requirements that drives different solutions. So over the next 10 years, for much of that time, we're going to continue to grow in the engines that we provide to our customers around the world. Our business last year was a total of $28 billion. And that was predominantly our core business for Cummins. This year, our Accelera business will be $350 to $400 million, so still quite small. Look forward to 2030. Mm-hmm. We'll continue to grow that core business. We project $33 to $35 billion. And the Accelera by Cummins business will become much more significant in the range of $6 to $13 billion. So through this decade, we'll continue to see growth across Cummins business.
Jennifer, is it unrealistic to expect in our lifetimes we're going to see roads where they're predominantly going to be Tesla Cybertrucks, not Cybertrucks, or the Tesla semi-trucks? Is that in our lifetime, or do we still need a massive improvement in America's infrastructure?
Well, there's a lot of investment required to build out an infrastructure and bring out the cost of these solutions. And it's important that we start today. So we are focused on some of the applications. We're putting infrastructure in place and making the economics work with incentives make sense, like bus applications, and you see that moving into medium duty. There, we're starting to see adoption of battery electric powertrains. The reality is for long-haul trucks, our view is hydrogen is more likely to be the long-term solution, either hydrogen-based engine solutions or hydrogen-fueled fuel cells, some battery solutions in certain truck applications, and that will take more time. So in my lifetime, I hope that we see many more of those trucks running on the road, but I do think it's going to be beyond my lifetime before we see that full transition.
I can't think of another company that has a better pulse in the economy 6 months, 12 months from now than a Cummins. What do you see in the United States? I think there's a lot of fears about a slowdown into the second half of this year. What does your backlog say?
Yeah, so we're coming out of a period where we had incredibly high demand and our customers were using their products heavily. There was, through the 2021 and 22 timeframe, a lot of supply constraints that prevented us from being able to build to the full industry demand. So what that's meant is, well, we've seen a little bit of softening in the economy. We still have very strong backlogs in many of our markets. And there's other places where we're seeing infrastructure and other things continue to maintain strength. So we're coming off of a record quarter for Cummins in Q2. We're projecting growth across the company for this year, but some softening as we get to the back half of this year in certain markets, for example, our heavy-duty truck, certain global markets, and even a little bit in the construction market.
I know you have a big business in China. Is that part of the slowdown you're seeing?
Yeah, China has actually been quite slow for the last couple of years, so really at a level lower than we've seen in many years as a result of the very stringent COVID lockdown policy and the sluggish economy that we see in China. So that market for us continues to be quite depressed. We're projecting some slow recovery, but really not seeing any dramatic signs of improvement in the market in China.
And I know it was, I'm sure it was a proud moment for you and your company when President Biden visited a Cummins facility earlier this year. I believe it was April. As we get into election season and whatever that might entail, what is the next administration, whoever it might be, what do they need to do to make your life easier in the world of manufacturing in this country?
Yeah, so we have made investments in our Fridley plant in part because of some of the incentives that have been in the Inflation Reduction Act that drive adoption of hydrogen and green hydrogen. So that's one of our businesses within Accelera is electrolyzers for green hydrogen production, and very excited about the business opportunity that we have there. We continue to advocate, across both parties and around the world for the legislation and incentives that we think will enable the transition that is necessary to decarbonize our planet. And that's something that we're going to continue to do. Those incentives are really critical to create certainty for businesses to invest and enable our customers to adopt these technologies today where they're still more expensive. By doing that, that then allows scale up and innovation to occur. And then the technologies will become more cost competitive, the infrastructure will be built out, and the economy can continue to thrive and sustain with these lower carbon solutions into the future.
Our thanks to Cummins Chair and CEO Jennifer Rumsey, as well as Yahoo Finance's Brian Sozzi.
There is a big issue facing the streaming giants as they compete for customers: subscriber churn rates. We have some new data out today from Antenna. Yahoo Finance's Alexandra Canal has the breakdown. So, Ali, where are we at with these churn rates?
Yeah, so churn is basically the rates of which subscribers are abandoning their streaming plans. And we're seeing that come as prices have ballooned across the board. We were just talking about last week how the golden age of streaming, it's no longer there anymore. But looking at this churn data, all the major subscriber platforms all saw their churn levels increase. Now, Antenna does define the monthly churn rate as cancels in a given month divided by subscribers at the end of the previous month. They all saw those rates increase except for one company. Well, who do you think it was?
Netflix.
Yep, Netflix. Now, the churn rate in the year ago period for Netflix was 3.1%. This was 3%, so a slight deceleration there. And you could think that's probably due to the fact that we saw the password sharing crackdown. Netflix also is just very broad in their content, which I think is critical. But a lot of analysts that I've spoken with said that churn, subscriber churn in particular, is one of the biggest issues facing these media giants, especially as profitability continues to be a struggle here with losses mounting as well.
So then, Ali, how do you think that then shapes their strategy, right? Because they need to raise prices because they need to focus on profitability, but also they want to keep those churn rates low. They want to keep as many subscribers as possible.
So there's a few things these platforms should be focusing on. One is original content and perhaps movies. So think libraries of content. That was one of the reasons why analysts were so bullish on Disney, because they have all that IP. They have all of those movies that can attract people to the platform. So if you focus on original content, that hopefully leads to engagement. Engagement is another thing that's important. You want people to be on your platform as long as they possibly can. How do you do that? By having a wide range of content that appeals to all different types of people, everyone in the family. That's something that Max is really trying to lean in on. It's something that Netflix has already been able to accomplish, and now they're adding more international content, which is increasing their exposure overseas, which is a great thing when you think about the writer's strike, the SAG-AFTRA strike, everything going on in Hollywood right now. So those are the things that I think will influence strategy moving forward. And with that, I think is going to come some M&A and some more media consolidation so that you can kind of cut your losses and bolster where you can. So TBD.
Yeah, it's going to be interesting to see who exactly partners with who.
It's going to happen. It's just a question of when. And you're right, which partners.
Exactly. But no surprise about Netflix. Though,
Yes.
You know, I mean, habits.
They're number one, man. It's crazy.
All right, Alexandra Canal, thank you.
Thank you.
Thank you, Ali. Coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set with everything you need to know for tomorrow. Stay tuned.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
All right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's take a look at a couple of stocks that are trending after hours. We got three names for you: UPS, Urban Outfitters, and Toll Brothers. Let's kick it off with UPS, moving to the upside of just about 0.6%. The headline coming after the close of the trading day that the Teamsters Union saying that workers have approved that new 5-year deal. Lot to talk about what this is going to do here for workers. Obviously, higher wages. And to put that in perspective here, $30 billion in new money is associated with this deal. Veteran delivery drivers will make $49 an hour at the end of this 5-year period, which will be about $175,000 a year. We've seen some of the concerns about the higher cost, the pressure that could put on UPS's business over the last month or so. We're looking at a loss of just about 11%, but year to date, the stock actually now in the red, off just about 4%. So some of that selling really coming over just the last couple of weeks as we started to get more and more details about this deal. All right, let's check out Urban Outfitters. That stock up just about 3% here in extended trading, beating on both the top and bottom lines. Record second quarter sales here for the retailer, up 7.5% on a year-over-year basis. So the two standout brands, Free People and Anthropologie. Free People sales were up 22% from a year ago. Anthropologie sales increasing 11% from a year ago. That helped offset some of the weakness that we saw in Urban Outfitters brand division. Year to date, it's been a winner in the retail space, up 42%. We'll see whether or not these gains after hours extend into tomorrow's opening bell. And let's round it out with Toll Brothers. That stock up just about 1.5% here in extended trading. We know home builders have really seen gains since the start of the year, accounting for more and more of the total homes built, as we simply do not have that resale inventory on the market. So not a surprise, strong quarter here from Toll Brothers. They also raised their delivery estimate for the year. That's a big reason why we're seeing even more gains here in extended trading. Year to date, the stock's up just about 52%. And the company also saying that obviously they're very pleased with these results, benefiting from the low levels of the resale inventory. Again, Toll Brothers closing the day just shy of $76 a share.
All right, it's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Retailers sounding the alarm on the health of the consumer. Both Dick's Sporting Goods and Macy's issuing weak guidance, and Macy's raising concerns about more customers being late on their credit card bills. Shares of both companies closing sharply lower on the day. Meantime, UPS workers approving the massive labor deal with major pay raises. It's a 5-year contract that not only includes higher wages, but also improved work schedules and other rules. By the end of the contract, UPS drivers will make around $170,000 a year, according to CEO Carol Tomei. The deal passing with more than 86% support, the highest contract vote in the history of Teamsters at UPS, that's according to the union. Plus, the Biden administration officially launching a new student loan repayment plan today. The administration says payments more affordable by reducing the amount owed each month and curbing unpaid interest. And it says tens of millions of Americans are eligible to enroll.
Now here's what to watch tomorrow on Wednesday. NVIDIA reports Q2 earnings after the bell. The street is forecasting $11 billion in revenue, adjusted EPS of $2.07. The stock is up about 220% since the start of the year. The hype largely centered around the AI frenzy. Now, a disappointing report that could put significant pressure on the stock that has really outperformed all of its competitors so far this year. We'll also get results from data cloud company Snowflake, the stock trading higher by about 6% since the start of the year. Apart from earnings, we'll get a read on the housing sector with new home sales out at 10 a.m. Eastern time. The street is forecasting 703,000 units in July, just slightly higher than June's numbers. And the stage is set for the first Republican primary debate of the 2024 presidential election. That's tomorrow evening, kicking off 9 p.m. Eastern time on Fox. 8 candidates will be taking part, but the GOP's frontrunner, former President Donald Trump, has confirmed that he will not be taking part in this debate. Instead, he has carried out a recorded interview with Tucker Carlson, which is expected to be broadcast on X, formerly known as Twitter, at the same time as the debate. That does it for us today on Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern time. We've got all your coverage leading up to and after the closing bell. We'll see you then.
Have a great night.